We're going to move to the next part of the morning now. I'm really excited to introduce my next guest. This is a one-on-one conversation with Dr. Nout Wellink. He is former president of the Dutch Central Bank. He has a wealth of experience working in national and international regulatory bodies. He has served as the president of the Dutch Central Bank, as I said, as a member of the governing council of the ECB, the European Central Bank. He has also previously chaired the board of directors of the Bank for International Settlements and chaired the Basel Committee for Banking Supervision. So extremely well versed on the macro side, on monetary policy, on what sort of supervision works and what doesn't. And of course, because he's hung up his central bank hat, he really does, in my experience, having spoken to him on the phone, tell it like it is. So let's hear from Dr. Nout Wellink now. Thank you very much indeed. Welcome. You okay? Good.
My pleasure.
We have plenty to talk about, and only half an hour to do it. Again, if you've got questions, do please shoot them to me. I can grab it on this app here now. Now, I'm going to start very quickly with the macroeconomic picture and the geopolitics, and then get on to the regulatory side. Have you ever been more worried than you are now by the confluence of bits and pieces happening, of the threats and the challenges that we're faced with?
The answer is no.
You haven't?
No, I haven't. I have been in this business since the mid-70s. I started as the Treasurer General of the Ministry of Finance in '77, and I have never seen so many serious threats as today. But I'm not forecasting the future. I don't know whether you're familiar with Doris Day, famous song, Que sera, sera. Whatever will be, the future is not ours to see. And that was what Keynes also said.
Thank you for introducing a little bit of levity into the situation. All right, so it's never been as bad as you see it now, and I imagine that's because a large number of risks have developed in a very short space of time. That's one of the pieces here. How long before, and again, I don't want to sound like a doom monger, but how long before confidence really could crumble, and what could prevent a crumble in confidence?
I really think you can't forecast this. I remember 2007, and I still remember quite vividly that even in April 2007, I had very specific questions to the US supervisor and central bank, and they all say they sung the same song as nowadays. We see a number of risks, but they all said at that time, but nothing will happen. So really, I think it's impossible to forecast something, but as to trade war, for example, the trade war, I don't know whether you have seen the recent study of the fund. If this continues, only the uncertainty of the first quarter already will have a negative impact on GDP growth in the world of 0.75%. That is to say, if this continues, then we might run into negative GDP figures for the world.
All right, well, look on the trade front, especially US-China, the uncertainty is huge there. Who knows? Maybe we'll get a deal. Maybe that threat will be taken off the table. What about your faith in central banks, the monetary policy side? How much faith do you have in central banks to do the right thing?
Yeah, but before you answering your question, I think one should make a distinction between the short term and the longer term. I wouldn't be very much impressed by, let me say, a short-term agreement between the Chinese and the US, because it's a long-term problem. It's about geopolitical change in the world, in politics and economics. Same holds for Brexit. Same holds for what is happening in Argentina and Italy. These are long-term problems. And now your question.
Very quickly on the back of that, though, I guess the reason I ask it is because the market reacts to short-termism. If there's a hint that there's going to be good news on the trade front, the markets react to that. If there's a hint that that Brexit's going okay, sterling rises. I guess when I'm talking about a crisis in confidence, I talk about that short-term market.
That will make the next crisis deeper, because it's artificial. It's purely artificial. If the markets react the way you are suggesting now, and potentially they will react in that way, then it's an artificial stabilizing or increasing of confidence.
Okay. Faith in central banks on the monetary policy side.
Well, you asked me to
to say it like it is.
To be a bit provocative, and I'll give it a try. But I remain myself. That is, I will say it a little bit more provocative than I used to do in the past. But I think that the central banks are on the wrong track at this very moment. They are focusing on stabilizing inflation rates at a fixed, more or less fixed figure, close to 2%. But if in today's world inflation is influenced by very fundamental other factors, globalization, technological developments, demographics, then you can do whatever you want to do, but you will not get in the short term or medium term at least that 2%. And the ideal example is Japan. They are fighting for a 2% figure for 2 decades already. The implication is that if you are still targeting such a figure, then your monetary policy becomes more and more outscale. And that is what is happening at this very moment in some parts of the world. So the starting point, to my mind, they should leave that starting point. That is one remark in this context. The other remark is that if a recession, you should look at the nature of a recession. If a recession is the consequence of a trade war, and this trade war doesn't come to an end, whatever monetary instruments you are inclined to use, it will not help, because it's not the right address.
So now, as far as you're concerned, the context looks grim right now.
Yeah.
Does it stay grim?
Well, some of these elements I mentioned will stay relatively grim. That is not to say that I think that on balance one should be negative, because there are also potentially at least very favorable developments with their own risks, by the way. One of them is low interest rates is like a kind of a two-edged sword. On the one hand, it induces people to make more debts. On the other hand, it's an ideal opportunity to invest if you make the right choices, to invest in future infrastructure you really need in the future. So it also offers you an opportunity. And this holds for me, I'm fascinated by technological developments, not only in the financial sector, but also in other areas.
Let's leave the economic context to one side and move on to another big branch of what we're talking about today, and that is fintech, big tech, the way the regulators deal with it. I'll throw it right out there, the regulator question, and it's something we'll touch on a lot more throughout the course of the day. What does a progressive regulator look like to you now?
I would look at some Asian countries at this very moment and what these countries are doing. Most regulators, but I left my own institution 8 years ago, and perhaps it's easier to talk about your colleagues than in the past. But on balance, supervisors are on the safe side when they look at fintech developments. And I do realize the problem, and I think you should do also. If I reflect on the past, on, for example, the Wright brothers, these guys went into the air as the first without a license to fly. But if they would have needed a license to fly at that very moment, we wouldn't have seen airplanes. And that is the dilemma when innovation is taking place rapidly. So I do understand the supervisors, but that being said, developments outside the banking sector go so fast that supervisors should do more than just monitoring closely the situation.
And a careful monitoring of the situation. We hear that phrase a lot.
That is the well-known phrase.
What does that actually mean?
That means that you're always lagging behind. I attended a meeting the other day in November, I think, in Basel, and I will not mention the name of the country involved, but the supervisor from that country told us that by definition, a supervisor is lagging behind. By definition, a supervisor is following what is happening in the private sector. To my mind, this is not the right answer for the future.
Should regulators be more excited about technological disruption than fearful of it? What is your feeling now? I mean, you no longer wear that hat, so it's probably easier for you to say now. You are on the board of a bank that is quite progressive in this space, ICBC in China.
ICB is very, very aggressive.
But just for a moment, take yourself back to the supervisor role. Is it easier to worry about it than to be excited by it?
Well, I think they should be more excited. And if I would be a supervisor at this very moment, I would be very excited. Let me say the following. Take, for example, digital money. Digital money is, to some extent, a threat. It is a threat to Libras, and on the other hand, it is also for supervisors, if central banks would create digital money, and they should do it in such a way that they can control the money supply and so on and so forth. But if they would do it that way, then it would be an enormous chance to even better control the situation. The digital area for supervisors makes it possible to get all the information in real time about their financial system from all the institutions, and to analyze with artificial intelligence all the interlinkages between the financial institutions. So I would be, but I'm a shadow from the past to some extent. I would be fascinated by also the new chances.
Yeah. Okay. Okay. You mentioned Libra. Let me just quickly throw a question in on the back of that. The regulators have been pretty negative about Libra so far, pretty much across the board. Why is that? Is it because they don't want to be seen to be too liberal with this? Is there a sense that Libra could actually destabilize the entire global financial system because of the systemic nature of the size of it?
I do understand why they are a bit hesitant.
You do?
Yeah. The reason being that Libra will be confronted with the same problems as regulators nowadays. Anti-money laundering, know your customer, and so on and so forth. And if you want them to stick to the rules of the game of banks, then they come under the same regime. Having said that, I have to add that Facebook, the recent history of Facebook, doesn't convince me that the money is safer in their hands, and that privacy, for example, is safer in their hands than in banks. And let me add one thing. A lot has been said about, let me say, the moral aspects of banking since the start of the crisis. But I'm not convinced yet, let me say, that the morality, the level of morality in the high-tech sector is as good as in the banking sector, or even better. So I can imagine that central banks and supervisors will have a very close look at this. And to my mind, the results should be that they speed up their activities, for example, with respect to digital money, with respect to cross-border payments. If they do that, there's no need for Libra. Let me put it that way.
We will hear from regulators, as I said, throughout the course of the day on this, and I'll try and push this with them. But it seems to me that regulators face a real conundrum here. On the one hand, it's about giving tech companies, in the name of competition, the space to disrupt the banking industry. But of course, that is at the risk of leaving behind a very large, unprofitable banking sector. which they can't do either.
Yeah.
What do you do with that conundrum?
Now, let me first say that the banks are to be blamed themselves to a very large extent to the lack of profitability. They should become much more efficient. And that was not necessary in the past because they could earn their money relatively easy. But what I am inclined to say is that banks should become high-tech companies. And this morning, in a, by the way, brilliant speech, this morning the speech started with the dinosaur.
Yeah.
And Bill Gates already said in 1994, banks are like dinosaurs. And the issue is how to make a dinosaur run. And banks should change, therefore. They should become tech companies. They should cooperate with tech companies. They should get an attitude of a startup. They should change their business model, and so on and so forth.
And can we wait that long, I guess? Because this takes time.
They can't, no.
And it's a change in culture, it's a change in mentality. And just on the back of that, so I guess the question needs to be, a bank doing a deal with a fintech or changing that culture, changing that mentality, can it really keep up with big tech? With Apple, with Amazon, with Alibaba? Can it really compete?
Well, I'm on the board as a non-executive director of ICBC. I see in practice how active this bank is when it comes to introducing new technologies. And more than 90% of all its transactions nowadays are digital transactions. And I think 450 million of their clients are banking digitally. So it is possible. But that said, and I've been part of a kind of international grouping discussing these issues, my experience is that a number of banks are reacting too slowly, much too slowly. And at the end of the day, they will not survive. At the end of the day. Because what a bank can do, others can also. So
I mentioned, Nout, in my open this morning, this ability or this realization among the new entrants of how you need to engage with the client base, the millennial client base, and really understand it.
Yeah.
And it seems to me big tech understands it a lot better. Is that fair to say?
That is fair to say, yeah. And big tech has an advantage for banks, talking about profitability and coming back to that issue. Big tech makes it possible to introduce more than is the case nowadays, inclusive finance. Because big tech is more inclusive, is reaching more people than the banks. If the banks do realize that inclusive finance might become a profitable business also in the future, not at the expense of these people, but because there are so many people involved, then I think they have a chance. They should realize that the two main drivers are technology and changing consumer preferences. These are the two big drivers, and banks who realize that, I think they can make it.
What technology excites you most right now? It's something we're going to talk about in the next session, but when we look at AI and machine learning and Internet of Things, what excites you most right now?
What excites me most is indeed artificial intelligence, and then immediately linked, of course, to machine learning, because this is a marvelous example of the difference between old-fashioned banks and new banks. If you look at the lending of traditional banks, they look at the client, they have a nice discussion, they collect soft data, they collect hard data, and then at a certain moment they come to a decision. Okay, you get a credit. And this is a discussion I had the other day with a supervisor, because this is the traditional approach. Supervisors are in favor of that. Know your customer, know them personally. Artificial intelligence and machine learning is different. They collect a lot of information from the internet, from all kinds of sources. And then on that basis, at a certain moment, they come to a decision. And My experience is, and I had a discussion with a supervisor on that, the supervisor, he told me, yeah, but I feel uneasy about this approach. You should know better the client himself or herself. This is, but if you, as the ICBC has, if you have 650 million clients, then you need this modern approach, and you need artificial intelligence. Yep. I'm really fascinated by the future brought to us by artificial intelligence in all areas, I have to say.
All right, and just on the back of that, I want to say, when I spoke to Nout on the telephone a few weeks ago, the last thing he said was, the thing that upsets him most is that he's probably not going to be around to see the real, or a normal eye, to see the real excitement in this sector, to see really what happens in this sector. Look, the questions for you now are coming in hard and fast, and I want to get to some of these. We've touched a little bit on this, but just to go back to it, big tech, large and unregulated, systemic risks. I mean, this is clearly an issue here. Yeah. What needs to happen in terms of regulation of big tech and fintech?
It is a very difficult question, and this is the balance between giving innovation a chance and freezing the situation. But I think that with respect to big tech, you need a number of the rules the banks are also confronted with. That is, I'm really certain about that. And this is also what our societies want. The example of anti-money laundering. Anti-money laundering, what we are seeing nowadays is, we are seeing in some countries the shadow banking sector exploding. Also in the US, by the way. You see the shadow banking sector exploding. But at the same time, our societies do not want that if you restrict banks with respect to any money laundering, that it goes via Amazon.com. Or these big tech companies. And that is happening already. One of the consequences of tighter regulations is that explosion in the shadow banking sector. Yeah. So big techs, more or less in fundamental areas, the same rules as banks.
Okay, a question here on, back to Libra. Digital currencies like Libra claiming borderless global appeal from day one. How can central banks enter such a domain with a new mass appeal? And I guess the question I ask here really is, are central banks, are regulators happy to have a rival issuer of money operating in their country, in their region? Will we ever get to that, do you think?
Well, I'm certain that they don't like it. They don't like competitors. That is self-evident. I think the real issue is, what is money? We are now talking about the fundamentals of the whole system. Money is something that is accepted generally by the public at large. And that basically is the reason why there is a guarantee by the government. It has a legal status. And nowadays what is emerging is something that looks like money, that can't fulfill the major tasks of the money to the fullest. And that makes central banks feeling uneasy.
Mm-hmm. In terms of regulation, and I go back to your experience, and whether we need a sort of global coordination or coordination of any kind. My question is, can national regulators act alone if they really feel the need to? When you were with your supervisory hat on, there was the big ABN AMRO issue in your country on the back of the crisis, where you, correct me if I'm wrong here, but you desperately wanted to act on this but couldn't because the bigger, higher-up authority wasn't prepared to.
No, I honestly speaking, reflecting on what happened during that period, I still feel to some extent frustrated. And the lesson I draw from my experience in 2007, 2008, is that regulators and supervisors in a globalized world should work together much more than they were doing at that time, and even more than they are doing nowadays. In a globalized world, you need globalized regulatory institutions. And I'm, honestly speaking, I'm also worried about, in the monetary field, about the relatively weak position of the International Monetary Fund. It is easy to say, just to give you one example, and I promise to be short. Yeah. It's easy to say, liberalize the RMB. But let's assume that the RMB would be liberalized for 100% and would show, could show the same movements as the dollar nowadays or the euro. Taking into account the savings level in China, this would be a disaster for exchange rate, the exchange rate configuration in the world, and for monetary policy and so on and so forth. So what you need is an institution in a globalized world. You need an institution, also a globalized IMF, and the same holds for regulation.
Do you think we could see a financial crisis similar to 2008 in the next couple of years?
No crisis is the same.
All right, as severe as that crisis, with the ramifications that we saw back then?
Not stemming from the banking sector. The banking sector is much stronger with respect to capital and liquidity. Risk management is better. There are less perverse incentives. But as I said, the non-banking sector is growing rapidly. By the way, financially fed by banks, because banks often finance the shadow banks. So if there is to be a crisis, it might come from the non-banking sector. I think in the telephone call we had, I mentioned the figure. The other day I heard from an American colleague. He said that in the US, mortgage lending, at the start of the eve of the crisis, amounted to 30% of the market. Nowadays, non-banking mortgage lending had 30% of the market. Nowadays, it's almost 70%. Yeah. That is to say how fast that sector is.
And finally, and very quickly, if the next crisis is sparked, if the next crisis is a Silicon Valley crisis rather than a Main Street
it might be a cyber crisis.
A cyber crisis. Then the worry there must be, despite all the experience we've gained in handling banking crises over the last 10 years, we haven't got the experience to deal with a cyber crisis. Is that right? Is that the worry?
No, we haven't.
Okay. Nout Wellink, thank you very much indeed.
Thank you.
Thank you.